at a time when we've got changing both, quite a bit of variability, both in terms of the financial sector, but also in terms of weather and those types of issues. One of the points that we wanted to are we good, Anna?
We're almost, I'm getting your slides up. Those should be up in a couple seconds.
Okay, thanks.
Okay.
So why is whole farm revenue? Yes, and we're, if we can go back a slide.
Working on it. Thanks everybody for your patience.
Okay. Well, we can. So one of the things that is very important for folks who are selling crop insurance to understand, and part of the value of crop insurance at this point, is that crop insurance is now the main mode of addressing production losses and disasters. In the past, Congress used to do ad hoc disaster programs that might cover specific production losses, but they're really not doing that anymore. It's really happening through crop insurance. So making sure that folks have the full range of crop insurance on their farm income is very important. It's also a very important issue in lending, and I know that there are some that Farm Credit and some of the other banks have also been very involved in crop insurance, and so being able to talk about crop insurance in the context of allowing people to access credit and access investment is a very important part of the process. And like I said before, we know that we're facing changing weather patterns and more extreme weather, and having a safety net that people can use to navigate those issues is very important. Okay, moving on. So it's not a mystery, and I think it would not be a mystery to folks on the call, that specialty crop producers have been underserved by crop insurance over time, both because many specialty crops don't have specific crop insurance policies, and also because specialty crops are frequently sold through higher value markets, like direct markets, farmers markets, roadside stands, or as specialty things into to restaurants or local food or other things that bring in a higher than wholesale price. And in the past, crop insurance has always been based specifically on that wholesale price. Moving on.
Sorry, Scott.
Next.
There we go.
Okay. So whole farm revenue crop insurance is new. It's only a couple of years old, and it's changed significantly over those couple of years. So if folks had experience with AGR Lite back in the day, back when that was being sold, we highly recommend that you take another look at whole farm revenue, because it's a very different policy, and a lot of the lessons that we learned under AGR Lite, we've changed and reformed in whole farm revenue to make it easier to use, to make it more direct, and to make it more cost effective. Whole farm revenue is also an opportunity for agents to differentiate themselves in the marketplace by understanding how this policy is administered and how this policy works. Frankly, having agents who really understand it and are able to sell it has been one of the limiting factors. And so there's a real opportunity for agents who are so inclined to be able to differentiate from other companies by getting out in front on this type of policy. Next. So the good stuff about whole farm revenue, you may have heard some of this before, but I'm just going to go back through it a little bit. It incentivizes diversification. So basically, the more diverse the operation is, the better the deal that they get, the higher the level of coverage, and the higher the level of subsidy. It can recognize a proven farmer price. So if a farmer either has a contract or has a history of receiving a certain price that is documented over time, even if you're selling, I don't know, left-handed orange-green tomatoes that are only raised on, southern slopes in the dead of winter or whatever, that have a higher value, if you can show a history of being able to get that price, you can get insurance at that price. And as I said before, a lot of specialty crops did not have insurance in the past. This allows those to be insured. Next. So the whole thing, the thing that is insured is the revenue from the whole farm operation. The value of that thing, the value that is up for the insurance, is determined by a 5-year average of the Schedule F filed in the person or the farm's taxes. For beginning farmers who have less than that 5-year time, they can use 3 years, but only for beginning farmers. The loss then is also determined by the Schedule F from the following year. So part of the timing of taxes is that you have to file this before you file your taxes. So actually, for a 2017 filing, you would have the 5 years ending in 2015, because probably you haven't filed your 2016 taxes yet. So there is a delay. And then if you have a loss in 2016, you're not going to get the payment for that loss until 2017 because it's after you would file your taxes. So there are some delays in that timing because of it being based on your taxes. And the rate of coverage is, actually I got this wrong, Clif, I realized the rate of coverage is up to 85%, but there is no catastrophic coverage. Moving on to the next slide. So y'all are going to be familiar with MultiPeril. Whole farm is great for diverse operations who have significant income from crops that are valued at other than the wholesale price, or a wide range of things that might not have had specific crop insurance policy. Whole farm can cover the gaps between crops that are covered. Going to the next. But if a farmer depends heavily on one crop, they should look at a separate MultiPeril crop insurance policy on that if available. So for instance, if you have very significant income on your tomatoes, then you might want to take out a MultiPeril policy on the tomatoes by themselves. That MultiPeril policy can then be nested within whole farm revenue, with whole farm revenue insuring the rest of the production. So if they have a range of vegetables but are heavily dependent on, like, their tomato crop, they can get the MultiPeril for tomatoes and the rest, and cover the rest of their income with whole farm revenue. Next. So if Anna is farming and she's got a history of producing $100,000, her average gross revenue over time is $400,000, $100,000 each from each of these 4 crops. Because of the diversification, her coverage level is 85%, so it's $340,000 in coverage. And I think probably I don't have to explain this to folks who are active in crop insurance, but just sort of seeing how the whole thing works to be clear. So her coverage is $340,000. On to the next. So if she loses 50% of her apples and 50% of her lettuce, her income is $300,000. Now in the past, if she had 85% coverage on the apples and the lettuce, she would have gotten the $35,000 from each of those crops. But here it's combined. So because it's all combined into the whole income. So the whole income would be $300,000, and the indemnity would be $40,000. 340 minus the $300,000, $40,000 payment. Here's the next piece, though, going on to the next slide. If she were to have the same losses on apples and lettuce, but make an extra $20,000 on tomatoes and peppers, then that income would be $340,000, and there's no payment. So this is part of what the reduction in price here is, that there is a reduced risk because gains in one crop offset losses in another crop. One of the other important pieces here is that that is within a piece that I pulled out from the earlier webinar is that the subsidy on whole farm revenue is as high as 80%. And so with an 80% subsidy, you really have, it's really a very good deal, and can be very cost effective for a lot of farmers. So the application process can be complicated. So encouraging people to get in and get working on it early is always really good. It does cover minimal processing that is needed to bring a crop to market. So for instance, under the old AGR Lite, it used to be that if you put a crop in a box to take to the produce auction, then you had to subtract the price of the box. You no longer have to do that. But you do have to subtract that price if it is further processing that adds value. So anything like if you're bagging a salad mix, if you're chopping and bagging a salad mix, that's different. Something that is not something that just is required to bring it directly to market. And Clif is going to go over this in a minute, but the growth factor, the way that growth takes place and how that is addressed in your gross income average is very important to understand. Because if a producer grows faster than what is allowed, which we've seen in some cases, but there is a good, there is a pretty positive ability to grow beyond what your 5-year history gives. But if a person grows faster than that, the income off of that additional acreage or that additional production capacity still counts against because it would show up on their Schedule F, it still counts within their revenue, but wouldn't be covered in the indemnity, so that effectively can reduce their level of coverage. So that's just something that people have to understand going in. You can have some, if an operation grows very quickly, they can have production that counts on the income side, but was not counted on the covered side. So I'm going to stop there, and Clif is going to take us through some of the nitty-gritty of how this works and how to sign people up, and then we'll take questions. And thank you very much for being a part of this. I guess I would close by saying the role of agents and bankers in promoting whole farm revenue crop insurance is extremely important. Their ability to bring people into the system, help walk through it, really understand what it does and doesn't do is a really critically important piece of the puzzle as we go forward with this. And so I really appreciate folks being a part of the webinar and being a part of that process. Thank you all very much.
Great, thank you so much, Scott. I'm going to switch it over to Clif now. Clif, are you on the line? There you are. I can hear you. Yep.
All right, has my screen
Take it away.
Okay.
Yep.
Good afternoon for everybody. I'm glad you could make it, and I'm really pleased to be talking with a group of agents because I'm really excited about the whole farm revenue protection. I've did a lot of consulting work with agents in Texas, some in the Midwest, quite a few like Delaware, Maryland, one in Jersey, quite a few in North Carolina, and I did some in South Carolina. So I've worked a lot with agents on trying to promote this product and trying to make sure the agents are up and ready to sell it to the farmers and service them. I grew up on a small diversified farm, so this is really important to me. A lot of the crops that we grew could not be covered. Still to this day, we grow a lot of crops, sweet potatoes, watermelons, pumpkins on our farms that cannot be covered, and even in some cases like peanuts, you got to do a written agreement and go through all the hassles of a written agreement and all that to have coverage where under this whole farm it can all be covered. I'm a graduate of NC State, and most of y'all, if you've been with crop insurance very long, if you're an agent, you probably have seen my name or have heard of me. I was acting deputy administrator for a while there, and then I was about 4 years I was assistant deputy administrator, and I also was the Raleigh Regional Underwriting Director. I was a claim services director in DC back in the 80s, so with compliance. I did about everything you can do with crop insurance. All right, now, what does whole farm cover? I think we've hit this quite a few times, and I hope everyone understands that. It covers just about all the commodities that can be produced on the farm, including animal and animal products, even commodities for resale, up to 50% of the total. It does exclude a few things like sports, show animals, pets, this is real big as a sales tool, as an agent. Replant cost. If you have on your intended operation report and on your revised report when it comes out, if your value of a crop is $100,000, the revenue based for that crop, then you can cover actual replant costs for that crop up to $20,000. That is a real big sales tool. A lot of people in tobacco country buy it because if you sell MPCI on tobacco, you know there is no replant on tobacco. But a lot of places tobacco is grown does have a lot on the coast and places like that. We have sandstorms that will cut the tobacco off. Can have a late season frost, all those type things. So, or an early season frost, whichever way you want to look at it. So that replant can be really important even to a producer that's already buying MPCI on his tobacco. I know several people paid their premium probably for the next 3 or 4 years off of replants for this year. Not only tobacco, on peppers and several other crops. All right, the coverage levels, I think we've all got that down pat. You can buy anywhere from 50 to 85% at 5% increments, but you cannot buy the 80 and 85 unless you have at least 3 commodities. You cannot buy catastrophic level. Question comes up all the time. A lot of people get caught in a trap. They will buy cat coverage on their wheat. So for 17, if you've got cat coverage on your wheat, you're not eligible for whole farm for 17. That's the rules, and that's the way it is. So if you've got someone that comes in and talk to you, you cannot sell them whole farm if they bought catastrophic coverage on their wheat, and they cannot buy cat coverage on any of their other crops. But most time you work it out with the spring crops. The problem is that fall crop. Historic revenues adjusted to reflect for farm expansion. There's an automatic indexing process that the computer does, and explain that to you real quick. If the 5-year, 3 to 5 year average on your Schedule F is $100,000, and either 14 or 15, the 2 last years is going to be in the mix for 17 insurance, is more than that average, then the computer will automatically index. Now, insured can opt out indexing, but I don't know of anybody that does that. Expanding operations, Scott went over that. You can go up to 35% growth, which is excellent because a lot of our candidates for this whole farm are diversified operations that are growing. And so you can go up to 35% if they increase acres or increase crops. If they go from 10 acres or they add a new crop or something like that, they go from 10 acres to 15. All right, cost for market readiness operations may be left in the approved revenue, minimal required to make market ready. So Scott already covered that. If you have added value, they won't cover that. The stuff like whatever it takes to get it to market, that is covered. That was an issue with the OAGR Light policy. Other federal crop insurance policies covering individual commodities may be purchased. As we said before, though, they must be purchased at the BIPE level. They cannot be purchased at the CAT level. And remember to tell your policy holders, any indemnities from these policies will count as revenue earned under the whole farm. So if they take a policy under it and they get a check for $10,000 from the MPCI, that counts as revenue toward the whole farm. All farm revenue is assured together under one policy. You got 10 crops, it all comes together. It's a whole farm policy. Premium subsidy is available and depends on the farm diversification. Farms, let's go right to that slide. That's the easiest way to show it. This is another great sales tool. If someone has 2 or more commodities, it is subsidized 80%. So for every $1,000 of premium, they only pay $200. You can still, I've seen people buy it with 1 commodity because still it's 55% subsidy. So as you can see, this is another great sales tool. You show somebody this subsidy, and I have seen where the premiums are very reasonable when you run premiums for producers. Another thing that I'll bring up, and it may be later in my slides, but I'll bring it up now. If a producer buys crop insurance, let's say they got 5 crops, one of them soybeans. Okay, they buy soybean coverage under MPCI. Their overall liability for their whole farm is $100,000. Their liability on their soybeans is $10,000. They only have to pay premium on the $90,000. but they still have $100,000 coverage. We only pay premium. We don't make them pay double premium. And so that's another real good sales tool. Now, where is it available? If you're in the United States of America, you can buy it. Every county. It's the first crop insurance product available nationwide. Nursery is pretty much available nationwide, but this is one they tout is probably the first product that's actually available everywhere. All right, who can buy it and who can't? Qualifications. If you're over $17 million gross, top of your Schedule F, average for 5 years, you can't buy the product because you have to buy it at least to 50% level, which is $8.5 million. I will tell you, I know of a producer that's $30 million, and he said he would buy the $8.5 million coverage and pay the premium on that, even though it wouldn't be nowhere near 50%, just to put a floor in under his business. But USDA said no. If you're over 17 million, they say you've got to have a 50% coverage, at least they'll do. So if you're over 17, you're out. Another person, if you've got animals and animal products, it's over $1 million, you can't qualify. Or you've got nursery or greenhouse that's over $1 million. That does not cover floriculture. That is a question I asked specifically because I had a producer in North Carolina that asked about it. They grow peonies. They've got $5 million worth of peonies and they want to buy coverage. They've got 5 million peonies. They've got about 1 million in in cut flowers and about 1 million in bulbs. About 800,000 in bulbs. That does not, the greenhouse would count and your nursery products, but not floriculture. That's a totally separate product. That will not exclude you. Well suited for diverse farms. So if you know farmers out there that have 4, 5, 6 crops, all the way up to 7 crops, the premium rate gets lower and lower and lower. After 7, you don't get a diversity reduction, but up to 7 crops, you get a diversity reduction. More crops you got, cheaper it's going to be. This works really great for the people we used to could not insure, like the direct markets, specialty markets, watermelons, cantaloupes, hand-harvested cucumbers, all these crops. Available to all farms or ranches that qualify, and as we say, there are some limits to qualifications. How do you base the revenue? Insured revenue is the lower of the current year's expected revenue, so you have to put in an operations report which shows what the farmer plans to plant, what his expected production, expected price is, and then you come up with this year he expects to bring in $100,000. Then you do a historic revenue adjusted for growth, and let's say that's $100,000. He's got to at least plan enough to qualify for what his average is. We're not going to insure him for something that he can't expect to even bring in. I've already said this. Does diversification on the farm matter? It dramatically does. The more diversification you have, the cheaper the product is, all the way up to 7. Now, how do you come up with that diversification? You can put it in the computer and let it do it for you, but if you want a good idea of how to do it, agents, there's one way you can do it. Take the number of crops, divide that into his expected revenue. So if the expected revenue is $1 million, he's got 5 crops. Divide the 100,000 by 5. That's 20,000. Multiply it times 0.333. So that means each crop's got to have at least like $6,600 to be considered a commodity. That's a quick way to do it. Commodities providing small amounts of revenue may be grouped together. So if he's got 3 crops out there that's small revenue, you can loop those together to try to qualify for either to get the 80 and 85% level or to get another diversity factor to lower the premium. Eligibility for whole farm. Potato farms must have 2 commodities. That was determined years ago. The National Potato Council did not want revenue coverage, and that's still in our rules and regulations. So if you've got potato farms, you've got to have at least 2 commodities to be insured on the whole farm revenue. And you must have commodities insured with other revenue coverage must have 2 commodities. So what that means is that if you've got soybeans, corn, cotton that has a revenue program, if that's one of the crops all you grow, you can't insure under whole farm. You've got to have 2 commodities. And to have 80 and 85% level coverage, you've got to have 3 commodities to buy those higher levels. Diversification measure all determines the amount of diversification discount to the premium rate. That's up to those 7 crops. So if a farmer has 5 crops, his premium rate will be cheaper than someone with 3. Someone with 6 will be cheaper than someone with 4, all the way up. Whole farm, premium substitute farms with 2 or more commodities, that's where you get that 80% we just talked about. Whole farm covers revenue produced in the insurance year. So what that means is if you have product in a storage bin like corn, soybeans, or sweet potatoes or anything else, what we have to do is accounts receivable or an inventory. That counts this year. If you sell something from last year, that don't count on this year. It's just what you've grown that year. So what we do is if you've got it in inventory on your farm, it's inventory. If you sold it but have not got paid for it, that's accounts receivable. All that counts this year, but it won't count against you next year. I had some producers saying, well, will it count against me both years? No, it doesn't. It only counts in the year it's produced. Prices used to value commodities to be grown must meet the expected value guidelines in the policy. USDA, on their website, they've got a handbook under the handbook section, the whole farm handbook, that gives you a real good guidance as agents on what you can and cannot use to establish the price. Now, if a farmer can come up with his own price based on 3 to 5 years of his own records, that's wonderful. Use his. That's what you want. You want to try to get your producers to give their own production records and their own history. But believe me, all of them will not do it, and you know that. If you sold MPCI, getting production records is the hardest thing on earth. And there is ways that you can come up, but it's to the farmer's benefit, use his own. What's covered? Natural cause of loss, decline in market. This product covers a wider array than any product that's ever been designed by USDA before, because it covers price. If you lose your market for some reason outside of your control, all those things are covered. I have asked USDA, RMA tons of questions, and as long as it's outside of your control, most things are covered. Taxes must be filed. That's one of the pitfalls that you hear farmers, one of the big complaints they'll say is, I got to wait till I do my taxes to get my indemnity. Yes, you do. We've got to do next year's taxes. So if you had it for 16, one thing it does is makes people quit having extensions on their taxes. IRS should like this. It makes people get their taxes in early, because the earlier you file your taxes, if you're in a loss situation, the quicker you get your indemnity. And it comes down real simple at that point. When the revenue to count for the insurance year is lower than the insured revenue, bam, you get a payment. That's pretty simple. It takes 5 years of tax forms, but as of last year, you can use 3. To qualify for this policy, you must have Schedule F or information that we can do a supplemental Schedule F for 15, 14, and 13, if that's the only 3 years you farm. If you farm more than that, if you farm 6 years, we've got to have 15, 14, 13, 12, and 11. So you can use 3 years if you've only farmed those 3 years. But if you farm 10 years, no, you can't just use those 3. So it's 3 to 5 years. Most farmers has been in business for a long period of time. They'll use the last 5 years. We have calendar year and fiscal year filings. So either one will work. Information about what will be produced on the farm during the insured year is required. That's an intended farm report. You have to do that by February 28th. That is one of the issues that a lot of agents have, is there's a lot of work to do with this policy up front. It's not a lot more work than MPCI policy. It's just all got to be done at one time. With MPCI, you just have to sign that application by the 28th. Then you can put in the production report. Then later on, you can do the acreage report. All this has to be done before the 28th. That's one of the biggest issues, and so you want to start early. I told farmers, we just did a webinar for farmers, and I told them, you want to call your agent right now. So if you're selling this product, you've got to start early. One thing to keep in mind, the other things such as supporting records, organic certification, inventory, accounts receivable, you got to have all that information also, and you have to put that in with the policy. This is a little bit of how the operation report works. Up front before the 28th, you do the intended, or before March to 15th or January 31st, whatever your sales closing date is. You have to do the intended acreage report. Then in July 15th, you have to do the acreage report, which is the real acres. This is just what's intended. And then before the final sale, before the sales closing date of the next year, you have to do a final report. If they don't do that final report, they're limited to 65%. So it's really critical, agents, you make sure you do that final report prior to the 28th of March or 15th or January 31st, whichever your sales closing. and this is sales closing dates. I've got up there, and you probably know what the date is in your area to be specific. These revised acreage reports are just like the revised operation report is just like the acreage report. It's got to be done. It's the real acres. What is the timeline? Here's the timeline, the billing date, which is good like all product, most of our products, and at the harvest date. So August 15th billing date on it. And I've already said about the final operation. Okay, how do you purchase it? Like all of our products, you purchase through a crop insurance agent. Get out and advertise the product, sell it. I mean, it's a great product, and I'd really tell every agent out there it's a great, opens brand new market for agents. It's a brand new marketplace. We've been competing, agents have, against each other for quite a few years with MPCI product. Now you've got a product, you can go out and search for new markets. Okay, so I'll end right there, so my time's up, and we'll be open for questions.
Great. Thank you so much, Cliff. That was really great. So I want to encourage everybody who's participating to ask some questions. We have a small enough group that if you want, we can unmute your lines and you can ask them verbally, or you can put them in the question box. And hold on, I want to make sure we get the right screen up. Okay, so I have a question while folks are thinking of questions to ask. One of the questions for you is how, Cliff, you touched on this a little bit as you were closing, but how much time do insurance agents need to kind of sit aside to get a whole farm policy going?
Well, to get it going the first year, it does take some time. It's not for somebody that just wants to sign a piece of paper. One thing you've got to do is you've got to start with the confidentiality from the farmer, because he's got to give you his most private of information, which is his Schedule F and his tax forms. I don't want to see his total tax form. A lot of them do send it to me. They say, hey, can you look at this and tell us what will happen? I say, don't send me your whole tax package. All I need is that one Schedule F. Now, the thing to remember about the Schedule F, though, is down at the bottom, some accountants will put Exhibit 1, Exhibit 2, Statement 1, Statement 2 for the expenses. You need to get all those statements also. So if you see anything at the bottom that says statements, because some expenses are allowable, some expenses are not allowable. The handbook lays that out real plain. You don't have to guess at it. And then when your company underwriter looks at it, if you did something wrong, they'll get you straight for you too. But how much time do you need to do? Once a farmer decides he wants to buy it, you've talked to him about he wants to buy it, you can probably do a policy dependent. Now this is a real tough question, because if he's only got 2 crops and both of those are easy to get a price and a production for, it's going to take you no time to do the paperwork. I can do it in an hour. But if he's got, like, I know one farmer that I work with has got 42 crops. So with 42 crops, and a lot of these crops, if he's got 42 crops, a lot of them are not mainstream crops. So I had to search for prices, markets, and all that. I spent 2 days on that policy. So it all depends on how much information and not only how big the farm is, but how diverse they are. If you're talking about watermelons, cantaloupes, corn, tobacco, and sweet potatoes, I can do a policy like that in 2 hours, hour and a half.
Awesome, thank you. And so another question I had was, it sounds to me like locating the price information for diverse crops can be a complicated process. Could you talk a little bit more about how that's done?
Very complicated. That is the most difficult part of this. It's not difficult to look on a Schedule F and put that in a computer or put it down on a piece of paper, because it's right there for you. It's not difficult with expenses, because the handbooks lay out exactly what's allowable and what's not allowable, and once you get that in your head, you can just go through it. You can let an administrative assistant in your office do all that. Coming up with the production, if a farmer does not have his own production records, if he or she does, you can use their production records and their prices, but a lot of your people will not have that, so you'll have to go out searching. You can use NAP, has price sheet for all the crops, which in a lot of states is real big. Like in North, South Carolina, Virginia, all the way down the East Coast, they have net prices for almost every crop under the sun, aquaculture, commodities, everything. So you can use those. Now, mind you, those are very conservative. So it's to the farmer's advantage to him to have his own records. He or she needs about 3 years of records for USDA to really think they're justifiable and verifiable. They want like 3 years of production and 3 years of price. NAS has prices. Agriculture Marketing Service, the marketing service for each state has prices. You can go to a lot of the brokers. You know, a lot of your big companies that, let's say, that buy tomatoes, peaches, apples, you can use, you can go to them and get prices. What we're trying to do is come up with exactly what that farmer can sell that product for. That's what we're trying to get at.
Awesome.
And one thing to keep in mind, straight black and white on that issue. That is one of the things that a lot of agents come back and say, well, we're used to having a handbook that tells you exactly how you do APH. That we do have a good handbook, and it does give you a lot of parameters, but they leave a lot in this policy, and they got to, because it insures everything under the sun. They got to leave some room, some wiggle room, we call it, for the agent and the underwriter of that company to work together, but you've got to justify what you do. That's the bottom line.
Great, thank you, Cliff. I just want to remind folks on the line that there's a functionality in your webinar pane where you can click a button to raise your hand, and that's how I can know that you have a question to ask, and then I can unmute you. So feel free to use that button. And I guess another question for both Scott and Cliff is: are there any common mistakes or sources of confusion that you've seen insurance agents run into when they are getting started in offering this or creating these policies for people?
Now, you were asking, is there a mistake that agents make in doing it?
Oh, not mistakes. Sorry, there's just sort of sources of confusion, I guess. Sorry, I should have.
Well, the biggest confusion, I think, overall with this whole product, I ain't gonna say confusion, but the toughest thing is we're dealing with crops that are what we call specialty or outside the box of norm. You're talking about crops that have not historically been insured other than under NAP, the non-insured disaster assistance. And a lot of them have not even been covered there in some cases. So trying to come up with production and price is the biggest thing. Other than that, it's pretty cut and dry, the policy is, in my opinion, other than the price of that, other than the price and the production to come up with that intended report. That is the biggest area that I know of that's tough in this policy.
I agree with Cliff. I would add to that a lot of the folks who are going to be most eligible under this policy are not folks who are necessarily used to navigating the crop insurance world. And while I think it is at this point underutilized, I guess one of the things I do think is that it really is an opportunity for folks that we have not thought about using it. Larger scale commodity growers, people who have a range of crops of any kind, mixed livestock and crop operations, and we're going to have a conversation in a week or so on commodities specifically. So I think it is applicable in places that a lot of folks haven't thought about yet. But also the farms that are coming in to take advantage of this are often people for whom crop insurance and talking to an agent and understanding how this works, there's a steep learning curve, and so it's going to take a little bit of time on the front end to get used to that and really get up going. But once they're going, just like it's true with a lot of policies that folks sell over time, once people have that process down and you're just renewing instead of having to start from scratch, then a lot of that investment cost goes down.
I agree, Scott, and that's where I said, in my presentation, I tell agents all the time, I'm really excited for the agents out there, because for years all we've done is fought over agents have fought over a set book of business. You know, all we've done is switch from one agent to the next and one company to the next. We've got a product now that can open doors for new agents or for agents that have sat there with a set book of business. Now they've got unlimited, because we can insure every crop under the sun. You've got a whole new marketplace out there.
Awesome. Well, here's another question. I'm interested in, I know that you both talked a little bit about how crop insurance is an important piece of farmers having access to credit. Is there any particular, for the finance professionals who are watching this, is there anything that they need to know in order to think about how, are there any other basic things that they might not know around how whole farm can help, can be useful in that? Like, are there any pieces that need to be connected there? I guess. Do you have anything specifically to say to credit folks?
Absolutely, absolutely. And I think, so in the conversations that we've had with bankers over time about the emerging markets, and these are the fastest growing sectors of agriculture, and the challenge over time for bankers has been some of the fastest growing sectors of agriculture were ones that were the most difficult for them to lend into, both because there weren't these kinds of risk management programs, but also because the banker didn't have a very deep understanding of the risks and benefits of that market. They didn't know it like they might know corn, beans, and cotton or something like that. And so there was a learning curve on both sides. And what we see with whole farm revenue is that it jumpstarts that process, because if a farmer, like I said, if a farmer is growing some odd, some crop that's going into a very different specialty market, them being able to access crop insurance is a game changer for the banker to be able to work with them and to lend to them over time. And what it means is that a lender doesn't have to just say no. The lender can say, well, let's look at this first, and then that opens up the door. So it's really an opportunity for them to access new markets and new business as well. So that access to credit piece was one of the main reasons we worked so hard on whole farm revenue, was because for people who are doing very entrepreneurial farming, and those are what is exciting and brings in money and is great about those emerging markets, and a lot of folks who are the next generation is coming back to the farm. What we see is as that next generation comes back, they don't want to do the same thing as dad and granddad did. They want to do something new and interesting and get into these new markets. The whole farm revenue is a way to sort of leapfrog that process. It can give the banker a comfort level with an enterprise that they may not have a high degree of familiarity with, may not have as high a degree of comfort with, and it's a way for them to keep that conversation going. We've had a lot of conversations with folks at Farm Credit and other ag lenders about how important this is in terms of just continuing the conversation to find a way for the banker to work with the farmer, especially that transition to the next generation.
Thank you, Scott. Cliff, do you have anything to add to that?
No, the only thing, I did a lot of work with bankers, because a lot of them are calling me now. They know I've done some consulting work with agents and with some of the lending institutions. I know of 2 cases last year where a farmer had, because of various reasons, had to go into bankruptcy, and they were out of farming pretty much. But this whole farm, one lender said, if they can buy that whole farm, we can afford the risk to loan them money. Now they greatly reduced their acreage, because they were in financial difficulty. They reduced their acres, but they're still in farming, and they've got a bumper crop this year. They're going to do really well. One of those people, I haven't tracked the other one, but with that whole farm, there's no way the bank could not, and the lending, it wasn't actually a bank, it was an agricultural lending institution. No way they could have loaned that money, because if you're a bank, one thing you got to understand, if you're a bank and it's a good farmer, which I wouldn't be insuring somebody wasn't a good farmer anyway, I do that homework, and they've got whole farm, you're pretty much guaranteed, if you take an assignment, what we can do is we can do an assignment of indemnity to that banker. So they'll be the first ones, if there's a claim, they'll be the first ones to get the money off that claim. So it's sort of like very, very low risk for that banker or that lending institution if someone has whole farm. You know, even if they have NPCI, you know, they could still have a loss and not get the actual money they were expecting to get. But with this, we're talking real money. You know, we're talking, if we guarantee you $1 million, you're getting $1 million, either you're going to make it off the crop or we're going to make up the difference. So that's a real good comfort zone to me as an underwriter. I'm not an underwriter from a bank, but I worked in crop insurance underwriting for about 12 years of my career, and that's a real good comfort zone there for me as a risk taker.
Great.
I tell you something I would suggest, since this is agents, not only going out and as an agent in an area, not only going out trying to beat the bushes with the farmers, I would go in and sit down with the agricultural lending institutions. I've did a lot of meetings for lending institutions over the last 2 years on whole farm because they don't want to farm, and that's what most farmers put up as collateral is the farm, and they don't even want that no more. They're like, we don't need the farms, we want you farming, and so they want to know more about crop insurance. In the past, a lot of them now, I never entice a bank to require it. I don't want a farmer to be forced into anything, but I tell them, why don't you look at it at a risk? You know, there's a certain amount of interest rate that's put in there for risk. So if that's 0.25%, you get a guy with whole farm, why can't you offer him a little lower interest rate because you know you're going to get your money back? And so I've worked with a lot of lending institutions. As an agent, you can open up a whole new book of business by doing that.
Awesome. Good to know. Okay. Well, if folks don't have any other questions, Scott or Cliff, do you have any other final thoughts?
Only that what we're seeing in terms of the future of where this goes, that this type of policy is going to be a very important part as crop insurance has moved more towards revenue-based products and has moved from farm units to whole enterprise units for other commodities as well. That this policy is sort of the natural continuation of a lot of where we've seen crop insurance heading for a long time. So it may feel like some folks as sort of a little bit of an outlier, but from what we're seeing from the agency and from Congress and from others is, you know, this is something that's going to be increasingly important over time. And it's while it was created and is most often used as an example for smaller scale diversified operations, there are many scales of operations that it can really work for, and there are a lot of those gaps in operations and, you know, sort of filling in the risk management hole that this is an important tool to do. The other thing that I would just finish off with is this is a pilot. It is going to continue to be adjusted a little bit, so I would really encourage agents as you're interacting with it, as you have ideas for how it could be adapted or shifted or things like that, getting back in touch with us, getting back in touch with Clif or some of the organizations that are involved in the call would be very helpful so that we can continue to make this as cost effective as we can make it be. And I'd stop there.
Thank you, Scott. And Cliff, do you have any final words before we sign off?
No, like I've said, I think this is an extremely good product, and I think it opens up a whole new market for agents. From the agents I've talked to start with, they were a little bit tentative about it. They're starting to learn more about the product, and as they learn more about it, they're excited because it opens up a whole new marketplace.
Great. Well, thank you everybody for joining us on this webinar today. Thank you so much to Scott and Cliff for taking the time and to share your knowledge and expertise. We will be sending a follow-up email with some additional resources, and if we can get it posted quickly enough, the link to the recording of this, you can share it with your folks who might be interested. So with that, thank you again. Have a great day, everybody.
Thank you.
Thank you all.